Hey everyone, hopefully you're having a good day. What we're going to go over today, my name's Andy, by the way, Finding Value Finance, if you're new. We're going to look at ratios, and ratios are market conditions and how assets are interacting with each other. So what I've got behind me now, and we're going to go into a bunch of different ratios. I'll kind of describe what they are. I do this basically once a week to give you guys updates on all this. I've got the CRB index to S&P 500 here, and we've been moving higher, which means favorable for the CRB index. The CRB is outpacing the S&P 500. If we take a long-term viewpoint here, we've got a downtrend line that's coming through. We've basically bottomed out, and we've been coming higher. Notice the big, large up movements and the small down movements in this ratio. On a monthly candlestick basis. It means that the CRB index is starting to get buyers in here. More and more buyers are coming in. They're buying the CRB index instead of the S&P 500. So we're getting an outperformance in commodities in relationship to the S&P 500. On a monthly candlestick basis, this thing looks absolutely beautiful. We are in a new uptrend. We broke the downtrend line. We've made a higher low, and now we're making a higher high. This should be a monumental shift for anyone on the channel, because what it's doing is that the ratio is verifying exactly what I've been telling people the past year. In 2020, we were early. We were buying the bottom. In 2020, we were buying the bottom of commodities. The reason I was buying it was because of the housing starts. The housing starts lead the move in commodities and the moves of stocks. That is our leading indicator. It is coming on up, and I think that we are coming into a commodity bull market. That's no surprise to anyone on the channel who's been on it. And the ratio is telling us that viewpoint is verifying that is a correct viewpoint. That's what this ratio is telling us. It's saying, yep, commodities are about to outperform stocks here at any point. And I think that interest rates are going up is going to help that move. It's going to rotate more money from stocks and bonds into commodities. So that's one I wanted to go over. Platinum to gold ratio is another one that's going to verify that thesis. I'm going to scroll back out at the top of the last bull market. If you saw this, 98.99 was the buy signal for commodities of the last bull market. The first one to move was the platinum to gold ratio. Platinum outperformed gold. It outperformed silver in the beginning of that bull market. One could play, if you want to try to do it the best you can, is you could buy platinum and rotate into silver. This is gold, but you could rotate into silver at this point here. But what we're seeing right now is we've got a bottom in this ratio. And yes, I swapped my palladium and gold for platinum right here. I didn't swap all my gold. I still own some. But I swapped a lot. I own a lot of platinum. It broke out. It did a retest. And now what are we seeing? On a long-term monthly candlestick basis, we saw a contraction in the candlesticks. We've got some support here where we've got this retest. And we've got a very large monthly candlestick developing in January for a potential move higher. We could see a very large move in platinum in this ratio against gold to the upside. And I think we could go all the way back to a 2.27 ratio. I swapped my gold at I think it was like 0.3 something, but let's say 0.4. If we were to go back to that ratio, just to show you what my potential buying power increase would be, if the ratio goes to 2.25 and I swapped it at 0.4, I got 5.625 more ounces of gold for every ounce of platinum that I purchased. So I bought 1 ounce of platinum and I got 5.6 back. Let's say there's some frictional costs. Let's say I get 5 back. So every ounce of platinum I bought down here or swapped for, I'm getting a 5 times my gold return. That's a real return. 1 ounce gold to 2 point something ounces of platinum. And I'm swapping it back here and getting roughly 5 times my metal back. That is what the power of this ratio is telling me. And this looks, as platinum outperforms gold, and this is exactly the pattern that we're seeing. This is a setup for a move to go higher for platinum to outperform gold. that is also signaling that we have an inflationary environment and that we are experiencing that. So that's another indicator. This ratio is another indicator that if platinum outperforms gold from liquidity type movements, that the markets are verifying and validating that inflationary thesis. Now, looking at the platinum to palladium ratio, platinum is cheap in relationship to palladium. Last bull market, it really took off from the 2000-ish time frame, which was our kind of buy point, and then palladium didn't do very well and platinum did very well. So platinum did well, palladium went down, and that ratio peaked in 05 and in 08. So platinum, I think, here is of a good buy. The platinum to silver ratio, platinum is of a better value than silver. That's what this ratio is. It's incredibly low. In the beginning of the last bull market, we got our buy signal in 98.99. If you had held on to platinum, you could swap it out for 140, 150 ounces. Or if you swapped here, 138, 140. That's about where you want to do your swap. You could have swapped into silver here, held it, and you would also, it went all the way down to 40-ish, and you could be swapping your silver for platinum and then ride the platinum wave. Now, again, guys, this doesn't mean that it's perfect. I own silver and platinum. I own both because they're both incredibly cheap. But I've been favoring platinum down here. So I've been buying more platinum in 2019, in 2020, and in 2021 and 2022. Platinum is what I've been buying. We're starting to see these big up surges on a monthly candlestick basis and the small return moves. So I think we're going to break to the upside eventually here with a big kind of surge higher, a consolidation phase, and then another big move is probably going to come. With, I think, platinum outperforming in the beginning of this bull market in commodities. At the end of the bull market, silver is going to be an absolute animal. It's going to be an animal, guys. So I own both because I got to, when silver's cheap, I got to buy it. And silver is cheap and platinum's cheap. Platinum is just cheaper. Gold to silver ratio. We're starting to see a move lowered. It's getting this return move higher in this thing, and we're probably going to see a break to the downside, meaning silver is going to outperform gold. Now, if silver outperforms gold and platinum outperforms silver, platinum will probably be the biggest star winner, I think, in the beginning of the bull market. Now, just because I'm saying this, guys, I don't want you to just go 100% into platinum because silver is a good bet too. I am divided amongst both of them. So I don't want you guys to get the wrong thing. I don't want to say that this will be 100% the fact of how this is going to play out. I am speculating on what's playing out in the near term. And that's kind of dangerous, okay? But usually based off of other history, platinum's done very well in the beginning of commodity bull markets because it's a very inflation-sensitive metal. And then silver seems to do very well on the back end. We'll see if that continues. I own silver and platinum. I'm just being honest and outright and saying, hey, look, I don't know how this is going to play out, but historically, that's how it's played out. Looking at the Dow Jones Industrial to gold average, you tell me what that looks like. That looks like a ascending wedge that's breaking to the downside. What this is signaling is that gold is outperforming the Dow Jones Industrial Average. It's exactly what we thought it would do. Yeah, it took a little bit of time. We took a little detour. The Federal Reserve held rates low and piled a bunch of money into the stock market that was favorable for stocks. Now that they're pulling back, the stocks are going to fall. So this was a false move higher. If they wouldn't have done this ratio would probably be way down here. I think that this is going to fall lower, where gold's going to outperform the stock market. The Dow Jones Industrial Average is going to outperform the S&P 500, and we're going to see a large compression lower. The gold to oil ratio, let's look at this here for a second. And we're looking at all these ratios because they mean something. The gold to oil ratio is at 21.5. It is still very cheap. Looking at a long-term perspective, we are still in this pattern going to the upward sloping channel. It's a slight ascent and a channel, and this is going to break to the downside. And I think we're going to go below 10. We're probably going to go back to a ratio that is somewhere around 6.5. So that's what we got last time, 6.5. If we were to get to a 6.5 ratio from this absolute anomaly up here, people are going to make so much money. They're going to be filthy rich from this low. Now, I can't go back in time and tell you guys to go buy it back then. And you know what? Most of you probably wouldn't have bought it anyway, because you wouldn't have had the confidence from a random individual on YouTube like myself to buy that low. You're going to have to get used to this. You're going to have to learn. You're going to have to train yourself, and you're going to have to learn what I'm teaching here so you can implement it at other times. This is still showing that we have good value in oil and that it's still going to compress to the downside. So if you're in your companies or you're buying stuff now, it's still of good value. Right now, if uranium's of incredible value. Uranium itself is incredibly cheap. And I'm going to pull up a ratio, a uranium ratio, and show you what that looks like. So I'm pulling it up here. Let me get myself out of here. And this is a pound of U3O8 in gold grams for December of 2021. I got this from pricedingold.com. This is courtesy of camco.com. This is where we're at. We're at a very low ratio of physical uranium, a pound of U3O8, in relationship to gold. The last bull market in uranium went all the way up to above 6. It's about 6.5. If this were to repeat itself again, and I think we're very early, and if you go kind of across from where we are today, we are below the bottom of the last bull market. The beginning of our buy signal of 98, 99 was up here. That was more like 1 or 1.25. We are below 1. What this is saying is that uranium right now is cheaper than the beginning of the bull market of last time in our buy signals of 98, 99 going into that expansionary phase. It went a little while sideways before making a liquidity, the liquidity or the money really started to flow into uranium in 04 and 03. That's when it started to really start to take off, and it just blew up to the upside. We aren't there yet. I still think we're early in the uranium bull market. I still think we're very early. So patience is needed. But that's the uranium to gold price there. This is the copper to gold ratio here that I'm pulling up. I like the big long-term view. We are still in this downtrend channel. I do think this is going to break to the upside at some point, especially in the beginning to middle of the bull market of commodities. The last beginning, copper stayed low until about 03, and then it really started to heat up. This first move could be from stimulus money. We were going sideways, and we're just waiting for the expansionary phase to kick in, where we get increased liquidity into the system. It may take a little bit of time. You just got to be patient. It's primed and ready, and I put the break question mark. Are we going to break this downtrend line right here and pop to the upside for an outperformance of copper in relationship to gold? And it could be a long-term kind of 4 or 5 year move. This one lasted from 04 to 06, the 2-year move up, and it lasted a while above here. I think that's going to be the same thing. It's going to be very similar in a move. Looking at the 10-year yield, we are breaking out of this downtrend line, and we've got a inverted head and shoulders, shoulder, head, shoulder. We're breaking to the upside, and this is the long-term downtrend. If this goes into an upward, breaking this downtrend and going into a new uptrend of interest rates, similar to this type of era, you could see a very large bear market in stocks with an increasing interest rate environment that just broke out of its downtrend. A lot of people hold the viewpoint. Their viewpoint is that interest rates can't go up because the government can't afford it. Well, you know what? That's their problem. It's not my problem. And if they have to spend and absolutely destroy the dollar in the process, I don't see how commodities, how they don't win in that scenario either, because the dollar going down, people are going to be running to assets that preserve wealth, which is your precious metals and your commodities, because that's of what has real value. It's under highly inflationary environments. If they decide to hold rates down and sacrifice the dollar, people are going to run to commodities and hard assets in that scenario, I think. And once they figure out that it's not transitory. I don't think it's transitory. I think they've killed that whole transitory narrative, and now you're going to see the money flows start to come. That's what's next. So we've gone over the 10-year yield there. Scrolling on down, I'm trying to think if there's any other ratios that we can look at. We've got the housing starts that are robust at 1.7 million. And we've got lumber. You know, I don't really use lumber for really much of anything. It does look like it's got a little bit of a peak here, that it could head a little bit lower, just because it's been on a tear. First, third, and then a fifth wave, and I don't know. It's hard to say if that's exactly the waves. But yeah, we could have a pullback here, but I think lumber is going to remain elevated. And I don't really use lumber as an indicator. I don't use the lumber to gold ratio. I know Michael Gayed uses that, but I use the housing starts. I think that's the purest form of liquidity coming into the system. It's the best measuring stick. And if lumber goes up, that's just a symptom of the housing starts. So that's not a root cause driver. And it's probably a pretty reliable indicator, just because the housing starts is the most reliable indicator. So it'd be the next best, in my opinion. And the volume of housing starts is what's pushing and moving this stuff around. So all of the ratios are looking good for commodities. I would be positioned in uranium's looking really tasty to nibble on here. And when it starts to come down and bottom, I'm going to be adding into it. So I think probably of any of the sectors, platinum and uranium are my favorite two at the moment. I've been buying physical platinum when it was down. I would be continuing to purchase into it. I buy 1 ounce Valcambi bars, physical bars, or Arger Heraeus, or whatever's cheap I can get my hands on. I'm buying as much as I can. And then for uranium, I'm buying my favorite companies. I just continue to pile into them massively. And eventually, when this thing turns around, that has the largest compression, in my opinion, of the ratio for revaluation higher. So I really like uranium. Like, I really, really like it. We're seeing prices in the energy crisis around everywhere remaining quite high. So Germany's power, electricity costs in Europe in general, electricity costs in Asia, they're remaining high. So why wouldn't they put uranium in? That's actually a cost savings measure. The renewables have not brought the cost of electricity down. They've pushed it higher. They've made the grids less stable. So if someone wants to decrease the price and wants a more stable grid and energy source, I think nuclear is a very good bet, and I think uranium is the fuel of choice, in my opinion. And if we continue to pile on all of these emissions type things, it's going to increase the cost of fossil fuel-based power generation and actually make nuclear more competitive. So I would say nuclear, in my opinion, is a very good spot to look at, which is AKA uranium. So those are my two favorite areas at the moment. Oil is also another one that I really, really like. The valuation, I don't think, is as good as uranium. I think uranium still has more movement ahead of it. It's got a larger upside move than oil. Oil has already taken off quite a bit. I owned a lot of oil, and I'm holding on to those, and I'm adding into uranium now because of the pullback. So uranium is where I'm looking, and will be adding, and platinum. If you guys like this analysis, give me a thumbs up. Subscribe to the channel if you haven't already, and thank you for listening. This is Finding Value.